Great. Thank you for taking a little time to go through the 2015 Nebraska farm averages with me. I just want to go through a few things that popped out to us as interesting information that came out of the data. One of the biggest things I think is important to do any year is look at what the underlying stories were that kind of led to where we are in these averages. And the biggest one was certainly the drop in livestock profitability. We saw farms, livestock operations who were on the top of the profitability scale in 2014 fall all the way to the bottom of the scale in 2015 due to what was happening there in the industry. That combined with a continued downturn in the crop industry combined to give us the lowest average accrual basis net farm income since 2002. We're also going to take a look at the debt load and family living information and how that played into the numbers in 2015, and also how we need to pay attention to those as we move forward into 2016 and 17. Let's get started talking about net farm income and just where we're at. Net farm income in 2015 came in just under $30,000. You can see that in the 10-year prior history, that is the lowest that we have on record, and certainly seems to be quite the outlier. If we take a look, and we will hear in a minute about the long-term trend, we'll see that this $30,000 net farm income profit actually fits in to the trend that would have been in existence from the late 80s to the early 2000s. And that leads to the question as to whether or not this is an old normal or a new normal that we're experiencing, as far as this is definitely different than the last 10 years. So since this was the lowest net farm income since 2002, I wanted to take a look and compare those 2 years and just talk a little bit about how those compare. But once we really left net farm income, not very much was the same between 2002 and 2015. You can see the average cash sale price that we received between corn and soybeans was $377 and $946 in 2015, and those were only $208 for corn in 2002 and $464 for beans. It gives a little bit of perspective for how low we think these prices are this year. And also, to remember that just 13 years ago we were excited about $2 corn, as that was the first time we recorded an average sale price above $2 in quite some time. Obviously, with higher prices and the same net farm income, it means expenses are up as well. So we took a look at per acre cost on irrigated corn and cash rented ground, which was actually down from 2014 to $791 an acre. But when compared to the $361 an acre we saw in 2002, certainly considerably higher. Same thing with family living expenses are down from $96,000 to $92,000, but again, very much higher than the $36,000, $37,000 we saw in 2002. One thing that's important to point out there is that margin difference between family living expense and net farm income was only about $11,000 in 2002, and now we're looking at over over 60,000 margin that we're short between net farm income and family living expense. Another thing that is considerably higher than 2002 is total debt, almost 2.5 times the amount of debt. That is up again from 2014 to the highest total debt we've had on record. And the important things to remember is we're talking about an average of $30,000 of profit to service $1 million in debt. And that's going to take a little bit of work to make that happen. Debt to asset ratio is one of the bright spots when comparing these 2 years, down from 39% to 28%. And that's a good thing. Debt to asset ratio is in a good ratio or good range. One thing that we do need to point out is that in 2011 we did make a land value adjustment, so part of this drop is due to an inflation in asset value, but the majority of it is due to earned net worth. Another good thing is the working capital to gross revenue is considerably higher. In just a few minutes we're going to look at working capital to gross revenue, and we're going to talk about how 28% is too low, but it is considerably higher than we were in 2002. I also have an accrual gross income on there and crop acres just for some comparison information for you. This slide shows us a crop and beef trend and net farm income. So these lines, an operation has to have at least 70% of their gross income from crops to be considered a crop farm, and have a combination of crop and beef in order to be a crop and beef operation. One thing I think is just important when we're looking at these numbers is to know that within averages we have lots of moving pieces and parts, and that each industry is moving at a different pace and different place, and we're also dealing with different operations within those industries that are also moving around differently. So just again an idea of the volatility and the diversification that we're dealing with inside Nebraska's agriculture scope. This is a net farm income trend from back to 1977. That was the first year we had data recorded by the Nebraska Farm Business Group. And you can see here, again, with that long-term trend, that $30,000 of profit doesn't look so out of place. Again, it's really the last 10 years that are the strange years. We just wish we could recreate them more often. One thing that is very different, though, that we need to keep in mind as we move forward is government payments. I've got 1996 to 2005 here on this chart, and then 2015. 2006 to 2014, we didn't see have a really significant impact of government payments, but I'm going to circle 7 years prior to 2015 here, where net farm income was less than or equal to the government payments received, which we also experienced again in 2015. One thing that we do need to keep in mind is that the 2015 payments were made up of CSP, CRP, but mostly ARC. And that's a payment that, again, is set to be on a 5-year moving average. So as we move into more years with lower prices, we will see those ARC payments fall off. And we need to be aware that if we don't find a different replacement for the income or a way to cut expenses, that we will be looking at net farm losses instead of net farm income. And that could happen as early as 2017 or 2018, depending on what prices in yields and other factors do. Just a couple things about the numbers. We're talking about a net farm income range from a -$1 million to 500,000 positive, so a $1.5 million swing between top and bottom. And we had 44% of our farms lose money in 2015. That's the largest number of farms we've had lose money in a long time. Gross farm income or gross income range from 14 million to 100,000. Age range from 23 to 82, and crop size from 0 to 5,000. Before we leave net farm income, I just want to talk a little bit about some efficiency ratios. We're talking about 4 ratios that add up to 100% that shows us where each dollar of gross income went after it came into the operation. Green is operating expenses, purple is depreciation expense, blue is interest expense, and orange is net farm income ratio. These give us just a little bit of an idea of how net farm income has shrunk over the last few years and how narrow that margin has become in 2015. We certainly are going to have to work on reducing expenses in all 3 of those areas in order to increase net farm income going forward. All right, let's just gears just a little bit and talk about debt. When we talk about debt, current ratio is the current position in general is the one that's causing the most immediate concern. Current ratio shows us our current assets divided by current liabilities, or how many times we can pay those current liabilities in the next 12 months with the stuff that we plan to sell. And current liabilities being the operating note plus any payments made on term notes that you're going to make in the next 12 months. We'd like to see that number be above that green line that I have on the screen. Anytime we talk about ratios, we talk about a green light, a yellow light, and a red light. Above that green line is the green area. Between the 2 lines is the yellow or caution area. And then below that would be where we'd have concern in keeping things going. So we've dipped into that caution area on average. Not the first time we've been there, but it has been a fairly quick decline from a very strong current ratio to a weak one in 3 years. a little different twist on the same information. We're looking at working capital as a percentage of gross income now. Put that goal line right there at 33%. We'd like to stay above that. You can see this number's dipped down as well. Makes sense because we're talking about the same numbers. Working capital, a little different than current ratio in the fact that we're looking at current assets minus current debt, or the cushion that we have. And then we like to take a look at that as a percentage of gross income so that we can compare different operations in different sizes. For example, a working capital of $100,000 is great for an operation that grosses $100,000, but it's not nearly enough for an operation that's grossing $5 million. So this allows us to put those operations on the same scale. And we'd like to have at least 33% of gross income in reserves as working capital. Both of these indicators show us that we are coming up on a time when we're going to be looking at cash flow crunches and potential problem getting those debts repaid on time. Not necessarily an overall problem, something that we can fix with maybe something like refinancing, but certainly an issue that's going to start to cause lenders a little bit of struggle in renewal and getting things paid back. If we look at the overall financial health of the balance sheet, instead of just the current position, we're looking at the debt to asset ratio now. Up to 28%, still in the green zone, so we're okay with that. But we have seen a little bit of a steady incline since 2011, and so it's just going to be a matter of how quickly that rises up into a position where we're concerned. You can see that we had that nice gradual decline, and in 2011, that 7% drop was in part contributed to the asset valuation change that we made in the land values that I talked about earlier. And one of the things that is concerning as we work with individual producers is we've noticed more and more operations who are starting to creep into that red zone for debt to asset ratio. And so I put together this chart showing the percentage of farms in each of those zones in each of the last 11 years. So I've divided the green zone into two. The bright green at the bottom are those that have less than 5% debt to asset ratio, or those that are basically debt free. And the red I have also divided into a darker green. Those are above 80% debt to asset ratio, those that are in a really tough financial position. If your current position is in a tight spot, but debt to asset overall is in the green, we could look at refinancing, getting a little bit more term, longer terms to make that debt. If your current position is tight and your debt to asset ratio is already in the red, then we definitely have limited things that we can do to help that operation move forward. You can see that we definitely had a nice gradual improvement in financial health from 2004 to 2010. And then from 2011 to 2015, we're starting to see less operations in the green, more in the red. That will be something that we'll keep our eye on as we move forward in seeing, again, how quickly the financial health of those individual operations starts to deteriorate. Overall total debt is another issue that we need to keep our eye on. For the last 3 years, we've been sitting right about $1 million in debt. That's double what we had 10 years prior. 10 most profitable years on record, and we doubled debt, which seems to be a little bit backwards in the line of thinking for most people. One thing that we can certainly attribute that to is the tax decisions that are being made in the deferral of that income tax, because what we've done is measured these balance sheets December 31st. In December, we've used operating funds to borrow money to make prepaid expenses, pay that down January 1st with grain sales or livestock sales, and that's caused our debt to increase as we go through this. Usually, we also need to look a little deeper about what kind of debt is increasing, because it is not just the operating note, it's not just land debt, it's really every type of debt. On this chart, I have your current debt as the green, that would be your operating notes. Intermediate would be the equipment purchases and maybe breeding livestock. Long-term would be land, and non-farm would be things such as a personal residence, non-farm vehicles, education, vacation homes, etc. And you can see every category of debt has increased in this time period. One thing I think that's really interesting that came out of the 2015 data is an increase in long-term debt and decrease in intermediate debt, with looking at some of the other numbers and not seeing a significant amount of land purchased in 2015, it leads me to believe that we're starting to see the effects of refinancing on the balance sheet when we take current intermediate debt, move it into the long-term position, term it out, give the operation more time to make those payments. And so I think we'll see more of that happen again in 2016 as we move forward. And as I've talked to producers and lenders who are now going through that as part of the renewal process. This is a little bit just, again, to give a bigger picture and a little bit more of an eye-opening awareness to where we've been with debt and how far and how big that debt has gotten in the last 20 years. And so, like I said, this is just a time lapse of that same chart from last time showing the increases in the amount of debt that each operation is carrying. If we take a look at the numbers behind the debt numbers, we're talking about a range of $0 to $13 million. Interest paid is $0 to $405,000 with an average of $34,000. All this is important in the fact that we're talking about rising interest rates as a possibility, but it's not as simple as taking an average of $1 million in debt and taking it times a 2% interest rate increase, because we know that money's not all borrowed for 12 months on the operating note, and we do have a lot of intermediate and long-term rates that are fixed, at least in the short term, at decent levels. So again, let's switch gears and talk about family living, and again, and the impact that that's going to have on the farm, because they really are tied more closely than you think. Family living in 2015 was down to $92,000 a year. Family living, again, is out-of-pocket things such as food, clothing, education, non-farm vehicle expense, charitable donations, those kinds of out-of-pocket cash costs where the money is gone. In addition, we had income taxes of about $31,000 and another $40,000 in non-farm investments and capital purchases. In total, about $164,000 going out in non-farm expenses. That's very similar to the 2014 numbers that we saw a year ago. If we look at the distribution of family living expenses, it ranged from $20,000 to $400,000. Pretty even distribution across all of that. You can see in the distribution pie chart that those in the purple section spent more than $200,000, so there's a significant number of operations spending that. But when we add those that spend over $100,000, we're talking about a third of the operation spending more than $100,000, and about two-thirds spending less than $100,000, with the majority being somewhere between $50,000 and $100,000. If we take a look at the long-term trend, you can see that family living has been pretty stable the last few years, but slowly falling. Last year was about $96,000. We're at $91,000 this year. Income taxes have fallen off a little bit faster than family living, but it's going to be a little while before we see income tax levels at the places they were in 2004 and 2005, because we have some of that deferred tax liability out there. We're going to need to do some reducing debt and keeping those taxes at a level that's a little bit higher. If we take a look at the non-farm income, or the net farm income trend versus non-farm living expenses, again, same chart that we looked at before with net farm income, but now I've laid the family living expenses there. You can definitely see a correlation between farm income going up and family living going up with it. But we really have never seen a significant drop in family living. And so that's going to be interesting as we move forward, because for 2015 is the first time in a long time that we have family living expenses higher than non-farm expense, or than farm income. And the longer we go with that gap over that, we're going to be looking at some significant net worth losses. Speaking of net worth losses, we had our first net worth loss since 2002 and our largest net worth loss since 1984, experienced in 2015. Over 56% of the farms that we work with had a net worth loss. So we certainly had a significant number there. The good news is that between 2006 and 2014, we built a lot of net worth, over $1.8 million of net worth. So to lose 50,000 of it's not a huge deal. What we want to make sure that happens is that we are able to curb this net worth loss and get things turned around, whether through reducing non-farm expenses, increasing non-farm income, or finding ways to increase farm income. If we take a look at the breakdown of this $92,000 of family living expense, you can see compared to 2005 that every category of expense has increased. Most people will want to say that it's health insurance and medical care, and while that is a significant increase, about 10% of the increase, it is not the largest increase by any means. The largest come personal care and recreation and miscellaneous expense. Hopefully these are both expenses that are disposable spending that we can quickly curb without affecting the way the family lives too much. Why is it all important? I just think it's so important to recognize the fact that non-farm costs can put you out of business just as quickly as cash rent or high seed costs. I just put together a very simple example of spending $75,000 a year. The taxes on that would be $21,000. Family living at $100,000 means we're spending $121,000, $46,000 more than we make. $46,000 every year over year after year starts to add up to a significant amount of money. This is going to come from extra borrowing, reduced working capital, and net worth losses. And those are not things that we want to see as we move into an economic downturn in the farm economy. Finally, we're going to take a little bit of time to talk about cost of production. We're going to take a look here first at irrigated corn on all tenure types. That means we've taken owned ground, cash rented ground, and share rented ground and averaged them all together so we could take a look at what the industry has done. The green line is gross income. The blue line is gross expenses. The difference between the two has been a nice profit margin for several years. 2014, we saw that margin narrow into a very narrow profit. In 2015, we basically saw break-even numbers. Remembering that in 2015, we saw record high yields almost all across the board. And so with those record high yields, we had a break even. So if we move forward into some planning with using trendline yields and similar costs, we're going to be looking at net farm or per acre losses. I started this chart a couple of years ago, and I've just been adding years of cost to it because it's been encouraging to see the way cost of production has come down the last few years. I started with 2009 because that was the last time we saw corn less than $4. And so we're certainly not back to that place from cost of production standpoint, but we're making big steps each year in reducing those total costs, and that is a positive improvement. Soybeans looks about the same, except we had that inversion into a loss in 2014. Saw it again in 2015, even with record high yields in soybeans as well. One of the major costs is machinery cost per acre. We've seen that come down for 2 years in a row now. That's, again, an encouraging thing to see. Hopefully this will continue to happen. Just remember that with machinery costs, we're talking about depreciation as one of those costs. And since we don't use tax depreciation, writing things off in the year of purchase, those costs for assets that were bought in 2011, 2012, and 2013 are still going to continue to affect this number and keep it relatively high for the next 6 to 7 years. When we take and break down machinery cost per acre, there's lots of things that are different than 2009. Also, just remember that sometimes the way a farm is structured can affect which category these numbers go into. For example, custom hire may not be all outside custom work that's being hired done. It may mean that they have a LLC or equipment owning entity that they share with a family member, and therefore their machinery cost has turned into a custom expense rather than a depreciation in repairs and fuel. So just keep that in mind, and one of the reasons why we add that up into a total machinery cost so it's comparative across all operations. Also, not a surprise to anyone that real estate and personal property taxes have been skyrocketing the last few years. Certainly don't have the political solution ready to go for this, but from a management standpoint, we do need to find a way to work around this until that political solution is figured out. Cash rent also saw a second year of decline. That's good news as well. Again, I think most of these declines were from built-in flex leases and bushel leases, but in 2016 I did start to hear of more actual traditional cash leases that are being dropped, as well as renegotiated so that we can have a more reasonable number. Again, and remember that this is cash rent across the entire state, which might make the numbers look a little bit low to you. This slide shows net return per acre broke down based on owned ground, cash rented ground, and share rented ground. Now remember that owned ground is always going to be better in the way we calculate things because we do not put an opportunity cost in there for the ownership of paid for ground. We only put in the real estate taxes and long-term interest that's being paid out of pocket. But being able to compare cash rent and share rent, it makes for an interesting scenario here. With this 10-year period, it looks like cash rent is definitely the way to go from a tenant standpoint, with just a little bit of a narrowing there in 13 and 14, but saw that gap widen again in 15. But irrigated corn is the only enterprise that we're seeing this happen on. If we look at dry corn, we saw that flip-flop between share renting and cash renting in 2012 to flip, and we've seen share rent be the better option there. Same thing in irrigated soybeans. We saw that flip happen in 2013. And come back together a little bit to a similar return in 2015. And dry beans showing the same thing, the flip happening in 2014. One thing that may be happening here is as we went through those years of high profitability and saw the cash rents go way up, we saw a lot of those costs being based strictly off of irrigated corn, and we maybe weren't taking enough advantage of looking at all of those enterprises and what was going to be planted on those fields, paying one flat rate across all the fields, including the dryland acres, and not taking into consideration that we needed to do a rotation with soybeans on a fairly regular basis. A couple of things here just to wrap things up. I wanted to look at irrigated corn cost production. If we take a look at the farm cost with an average long-term yield of 200 bushels, those are 2015's costs. We're looking at $3.96 a bushel, not too terribly far out of the realm of possibility of a profit with what the market is offering these days. 2015, we did see those record high yields, bringing that cost production down to $3.60. If we add in family living and income taxes over an average number of acres of 1,000 acres, we need to add $122.72 per acre, or 61 cents a bushel to that cost of production number, bringing it up to $4.57 a bushel. Certainly a little bit higher than where the market's at. Obviously, yield plays a large role in that cost of production number. Dropping it just a little bit to 150 brings that number to over $6 for corn, bringing it down again to that $4.16 if we can get yields similar to what we had in 2015. Also important to note that not anybody is average, that there's a lot of range in cost of production as well as anything else. High profit third, using the same cost of production or cost of living and 200 bushel yield, has a 411 break even, including family living costs, where the low profit third is looking at 488. So we're a 77-cent difference between the top and the bottom. Irrigated soybean cost of production is very similar, $11.29 for farm costs. If we add in that family living and taxes, same cost per acre is $2.05 a bushel. We're looking at $13.33 per bushel. Certainly, something that is not in the realm of the market right now. Yield again making a big difference of almost $4.25 or $4.50 a bushel if we can get that yield to come up a little bit, bringing that down into a more reasonable place, but still a fairly high yield expectation is still out of the money in the market. If we're looking at high profit third versus low profit third, we're almost a little over almost $3 a bushel difference from one farm to the next in cost of production. Watching your numbers and paying attention to where you're at is really important, because your cost of production is not likely to be similar to your neighbors or anyone else's for that matter. Finally, I just want to take a little bit just to give you a little bit of an idea of what would happen if we would just cut 10% across the board in expenses. Every expense reduced by 10% changes that cost of production number, leaving 60 bushels the acre, leaving, even cutting family living down, we're moved from $13.33 to $12 a bushel. Gets to be a fairly significant move for just making a 10 cents per dollar savings across the board in all your expenses. Well, I hope that was a helpful half hour of your time to spend looking at these averages. If you want more information, we have several books available on our website. Then we have 4 regional books, the whole state book, and our top efficient that looks at our most efficient operations. Those are available, like I said, for order through our website for Nebraska Farm Business members. You just give the office a call, and we'll be happy to ship one out. If you have questions, you can use that info@nfbi.net email address. We'll be happy to answer those questions for you. We're hoping throughout the summer to offer more webinars on a variety of topics. So you can certainly use that info box to make your suggestions. We'll be happy to try and help you out with that, with topics such as how to decide when it's time to give up cash-rented ground, maybe a deeper look in the top efficient farms, and some other things like that that we can use these data to talk about. Thank you for your time, and like I said, feel free to like us on Facebook, and where we'll be having those announcements of when those new webinars are available, or just check back at our website. Thanks.